Good day, ladies and gentlemen, and welcome to our new class. It's a brand new class for me, actually, the first time, on the art of entry and exit points. Now, I'd appreciate it greatly if you could click on the subscribe button below or the bell icon, either one. I promise you, we won't inundate you with emails. We'll just send you notices whenever I upload a new class. That's it. We won't bother you with anything else. So please subscribe. It's very important to me. Now, I started building this class, and I started out with the fine art or tips for finding entry and exit points. Then I went on to the art of entry and exit points. And I built this class and realized it is extremely long, too long to keep anybody's attention. So what I'm doing is I'm going to break this class in half. Okay. The first presentation is going to be on entry points, but you can't separate entry from exit entirely. So we're going to go through everything together, and then when we get down to actually starting your trade, I'm going to break it off there and go the second video on exit points and wrapping it up, just so it's not too long and boring for you, and you can pick whichever class you want. So the biggest question is, when's the best time to enter a trade? Now, if we knew the answer to that question, forex trading would be a lot easier. Unfortunately, the difference between profits and losses is your entry and your exit strategy. For example, you might estimate the value of a currency pair will appreciate, but if you hesitate to enter into the trade, you limit your potential profit. Typically, finding an entry point starts with solid technical analysis and a plan for action. You want to enter trades for a specific analytic reason. You've isolated a clear trend, and you want to have a plan for potential entry and exit points. But entry and exit point strategy is more complicated than that. Finding an entry or exit point for your trades is one of the most important skills you can master. Not understanding what the economy is doing, not understanding how to break down Facebook and how crude oils can do, not figuring out how to read MACD and how to do this and how to do that. Ultimately, there are two crucial points. It's entry and exit points. Entries start your trade. Exit points are where you book your profit. Okay. In between is just your trade. Finding an entry or exit point for your trades is one of the most important skills you can master. Now, these quick tips will help you determine when to at the best possible price, enabling your trades to capture more profits. Now, here are a few tips for entering, and we're going to look at some entering strategies. We're going to look at all entering, but things to keep in mind. Trend lines are your friend. Trend lines are extremely useful for day traders, and they can provide fast insight into possible entry points. They don't give you, trend lines aren't a strategy, but you can use them to isolate the price. Once you determine you want to make a trade, you have to determine the price you're going to enter the trade. And let's not forget risk-reward ratios. Okay, all of this gets interrelated because risk is something we always have to look at, and you can only do your risk management by knowing what price you're willing to enter a trade. Essentially, trend lines connect a series of higher highs or a series of lower lows, and they're extremely useful and easy to use. They provide a clear indicator of the support levels or resistance levels for a specific pair or asset. Entries can be determined based on the value's relation to resistance or support levels. As the value reaches the trend line, it's a good indicator that it might be time to enter a trade. So what do we want to do? Our first step would be to analyze the market and identify a trend. Research, learn, and understand what are the relevant correlations and factors that are affecting the market. When trading forex pairs, the first step is to understand what moves the various currencies. After learning about the forces pressuring a forex pair, you will know what to do with a specific asset. Forces include interest rate changes that can push a currency's price up or down, geopolitical factors like war, political unease, and supply and demand of a commodity like oil. Too much inventory also decreases prices, as well as natural disasters and natural supply and demand. You should never, ever be using market orders. Because if you're going to develop an entry strategy, your entry strategy should have a price attached to it. And you should be entering limit orders, okay, which lets you enter a trade at a specific value and ensure you enter the trade at the best possible value. You should only have a specific value you're willing to enter that trade. And if it's not touched or reached, you can't get that asset at that price, then you don't make a trade. Too many people do all of their evaluation. They go in and they just search buy or sell on their platform, and they generate a market order, and it ends up being 8 or 10 pips higher than what they had thought of for their entry point. It's important. Limit orders. Understanding order entry systems. So here's an example. The euro US dollar is trading at hypothetically 112.25, and you believe the price will dip slightly before trending back up. You set a trade order at 112. Now remember, it's trading at 112.25. The point you expect the price to drop before rallying to ensure you will enter the trade nearest the bottom of the trend. So it's trading at 112.25. You want it to go up, but you're not willing to buy it at 112.25. You're willing to buy at 112. So you set a limit order. If it never drops to that 112, you never made your trade. You never got into the markets. Okay. If you make the trade, if it executes your order, then guess what? You got in at a great price. So with the speed at which day trading occurs, this Forex strategy is extremely useful for locking the best possible price. Limit orders are orders to purchase or sell a pair at a specific price or better than they are. And they can request via a broker, as most platforms have them built in. Every platform, no matter who you're trading with, has at least basic limit orders. Some have more complex ones, and you should be trading with a broker and a platform that gives you a lot of options of type of limit orders you can enter. And then when you are placing limit orders, the basic rule says that a buy limit order will only be executed at the chosen price or lower, while a sell limit order will be activated only at a limited price or higher. Bear in mind that limit orders are not guaranteed to execute, as they must respond to precise specifications. Doesn't execute, you don't get in trade, you don't care, because the price you were willing to enter at wasn't met. Now, sometimes you might want to look at the time of day. So the peak of the foreign exchange market is during the US-London overlap, and the amount of noise in the market is high. That's why, particularly for long-term Forex trades, it's ideal to place entries at the end of each day. Although this might lead to overnight risk for a day trader, it ensures that prices will be the most stable and the trends very likely to be clearer. Now 3, use indicators. Technical indicators are preset statistical studies that provide you with crucial information about the market and Forex pairs. It will help you set entry and exit points, understand supply and demand, and possible swings among other data. You can create trading signals for yourself using one or more indicators. This will define exactly when to enter or exit a trade. Now, this is not a trading strategy using indicators, because you might say when this happens, this happens, this happens, I'm willing to buy. When price breaks the moving average, when price jumps out of the Bollinger Band, when price breaks the moving average in the Bollinger Band, that tells you, okay, I'm willing to enter the market. I'm willing to make a buy or a sell, or short or long trade. But something still has to help you determine the specific price you're going to enter the market. Now remember that no two positions are alike, so you can never entirely predict an outcome. Entry and exit point preferences will also vary depending on you and your strategy. So the best option is to find a trading strategy that fits with you and then choose the entry and exit triggers that are in line with your plan. And that's a great word, triggers. What price will you trigger your trade? Okay. You're sitting there, you got your shotgun loaded and ready. Okay. You need something to trigger you. If it doesn't happen, doesn't reach that particular price, then you never pull the trigger. Now, a significant amount of experts in trading will agree that psychology plays a major component in trading. In other words, your success as a trader depends a lot on your mindset. Understanding this, it is logical to conclude that how you think about your trades will have a major impact on your trading profitability. The most accurate you can make your entry and exit points, the more winners you're likely to draw and the more effective your trading system will be in meeting your objectives. Your goal for entries and exits is to add as many winning tickets into the draw as possible. So to add in a ticket that, when you do not pull them, give you a better chance of hitting the jackpot. So building a trading system is a little bit like building a house. When you construct a house, you decide how many rooms it will have, the layout, how many floors, and so on. These decisions are based on your needs, your objectives, your budget, your trading capital, and what suits your personality, your psychology. Similarly, when you develop entry and exit rules for your Forex trading system, or we say entry and exit rules or triggers, you choose things like risk reward ratio, win rate, and number of trades over a period of time. A risk reward ratio will help filter your trades because you need to have a price in which you're willing to enter the market, a target price in which you want to reach, and then you put that into your risk reward filter, and guess what? That filter says you can't make that trade regardless of what entry price you get. It doesn't fit your risk reward ratio, and you throw it in the trash can. You just move on, because filtering out bad trades or high risk trades is very, very important. So you need to be able to set or have a specific entry price so that you can fill in your risk reward ratios. Entry and exit should never exist independent of each other. This is a problem. That's why I couldn't just break this class in half. Their relationship can be expressed through the risk reward ratio. Your risk reward ratio is how much you can potentially profit on the trade compared to your initial risk. In order to do that, you have to have an entry point. You determine this by working out your initial stop and profit objective. For example, if you are risking $1 to make 3, you should have a risk reward ratio of 3 to 1. Now, there's also two different styles of entry, not triggers. You have entries versus re-entries. For the sake of system development, we define some types of entries as re-entries. Re-entries occur in two circumstances. The initial entry is stopped out, but the setup condition still exists. A breakout fails and then goes back within the range before attempting to break out again, and your position gets closed, but everything stayed the same. So you, like the crazy person you are, me like the crazy person I am, I still believe in that trade. I just entered it too soon. So the condition still exists. So I'm considering re-entering that trade. So the initial entry is successful, but you get a new setup that you want to take. You enter on a breakout and the market starts to trend. You then get a chance to add an additional position based on a pullback into trend. In other words, you enter a trade, it's doing exactly what it should do. You get a nice pullback and you have another chance to enter another trade in that same set of circumstances, a different price, but in a movement of that same trend. So that's also a re-entry. The trick to using re-entries is in the planning. If you just had a losing trade or are ready for a profitable position, it can change your psychology and cause you to make mistakes. So we come down to developing an entry strategy or an entry trigger. There are several factors you need to consider when developing an entry strategy. Why is the trade entry more important than the exit? Well, the very fact of deciding to open a trade is extremely important, because unless you open that trade, you don't have to worry about an exit. You don't have to worry about a stop loss. You don't have to worry about risk reward. So it's the first step. And if you are not in the right frame of mind and you don't stick to your plan, it's very likely you will end up with a losing trade. So everything from that point starts. This can be overlooked when we examine The results are purely mathematical back test. So deciding to put your money on the line all starts with your psychological state at the time the trade is entered. Of course, this is not the case if you have a purely mechanical trading system. But for traders who manually enter trades, the psychological aspect cannot be ignored. When you have a good entry, your probability of success goes up significantly. Your risk management is also very, very important. And see, your risk management strategy and your risk management is very personal. Only you knows how much you can afford to risk. Only you know how experienced you are. Only you know how much capital you have. And it's only you know how many times you've used this strategy. Okay. So how do you actually determine when to enter? That's a little bit scary, isn't it? So entry strategies that'll help make it easier. So we have simple entry techniques at work. Okay. Simple entry techniques allow you to focus on managing your trade once you enter, rather than on interpreting a jumble of indicators to work out the best time to buy. So we have the setup. A setup is a condition you watch for prior to entering your position. Once your setup occurs, then you move into the stalking mode for the high quality entry to set your trigger. And the entry, now you become a hunter, spear in hand, pursuing the high quality entry with dogged determination, because your whole entire setup could have been perfect, but you entered at the wrong point. So you are face to face with the markets, unwavering while you wait for the perfect moment to strike. So when it comes time, you execute with aplomb. Your supreme skill ensuring you net your target with ease. Or you simply set a limit order. Typically, you will look for a drop to a lower time frame from your setup to improve your risk-reward ratio. You could then employ technical analysis such as candlestick analysis for the actual entry. Now, multiple time frames is very, very important. A lot of traders don't understand it. Even though I'm a short-term trader, okay, I'm going to find my trigger with a 15-minute chart. I'm going to make my determination on a 1-hour chart, and I'm usually going to use a 4-hour chart for an environmental overlook. Okay, so first I look at my 4-hour chart and see what is going on. I move it down to a 1 hour, and I look to decide whether do I see an opportunity to trade? Not what point will I end. Do I see an opportunity to trade? Is there a setup here? Then I drop down to my 15-minute chart to figure out at what price I'm willing to enter that market and what price can I get. Okay. Once I do that, I drop that in my risk reward. So let's talk about simple entry techniques at work. For example, on the USD CAD, if you want to go to a lower time frame, you would see a strong reversal pattern. So here we were looking at opportunity. We dropped it down to a smaller time frame, and we saw a strong reversal, a spinning top followed by a bullish engulfing candle that will allow you to get in earlier and improve your risk reward ratio. So by dropping down our times, we got a specific entry point based on a candlestick pattern, if that's what we use. Entry methods at work. Almost all entry methods work, but they work differently depending on your setup, your psychological objectives, and the market type. So entry methods at work. Candlestick patterns. Now, we're not making a trading decision based on candlestick patterns, where we could have used them in our setup. We're looking for an entry point. An entry point might be the last long wick. Could be the higher high, the higher low. It could be when the last short body candle. Could be when you saw an engulfing candle, what was the open price. Okay. Whatever it is, price action candlestick patterns can be excellent entries, as these give you an indication of the buying and selling pressure between the market participants. Now, indicator crossovers are popular for their simplicity. They tend to work better in trending markets. Some indicators that can be used for this approach are moving averages, MACD, or stochastics. Okay. Now, one of the best ones is when price breaks above or below a moving average. Just for your trigger. Remember, this isn't your setup. This is for your trigger. Okay. And we can use breakouts. Breakouts are a great way to determine entry point. We can use a limit or stop order that enters automatically once the price moves outside of a range. So here we've got a range on our chart. And here basically we're using support and resistance levels. And we would set up an entry point when it bounced off of that top range, a stop loss right above, and we would be looking for a strong bar to make or to initiate that trade. Or we would wait for price to close outside of the breakout range. You may avoid some whiplash for this method, although at the cost of missing either the breakout or entering later with an inferior risk-reward ratio. And then we have classic chart analysis techniques. The idea behind this technique is to allow the trader to enter the market without delay after the directional bias is confirmed by price action. If the trend has been down, thus making lower swing lows and lower swing highs in place, and a sudden print of a new higher high, this is the first signal alerting of an eventual change in direction. Okay. If the next swing low is higher than the previous swing low, and subsequently the next swing high is another higher high, the new market bias is objectively confirmed. Now, this is not, and please don't mix this up with your trading strategy. This is your trigger points. This is the point at which you've entered trade. You've already decided you would like to buy or sell. You're looking for something to give you the price at which you want to buy or sell at. So trends tend to feature higher lows and higher highs in an uptrend and lower lows and lower highs in a downtrend. So what happens if you get a lower low in an uptrend or a higher high in a downtrend? Right, there's a high likelihood of reversal happening and you should look for an entry. So we have an uptrend, and when you see what looks at a low swings, you can keep on seeing higher lows, and at some point the distance between those higher lows gets smaller and smaller until finally you get a lower low and use that for your entry point. Of course, it also works in the opposite way. Everything's going to work for going up or going down. Then we have support and resistance levels. I swear by support and resistance levels. Gusty traders can enter on support and resistance, trusting in a level to hold. This entry can improve the risk reward of the trade, but can decrease your percentage of wins. Well, that's a lot of choices for an entry point. So in summary, here's a look at the entry process in its entirety. Wait for your trade setup conditions, whatever your setup conditions are. Drop to a lower time frame. Apply your chosen entry technique or trigger, and check whether the risk reward will be acceptable. Then set your limit order at that price and wait for your trade or trigger, because once you've entered, the real trading begins. Okay, till you've pulled that trigger, you're just a bystander looking. You're the guy behind the cage at the ballpark. You're just looking. You may be calling the strikes, calling the balls, telling him what to do. You may tell him exactly how he has to hit, where he's got to hit to. Unless you're that guy standing at the plate, swinging that bat. So once you enter, the real trading begins. So we're going to wrap it up here, and we're going to start moving over to finding your exit points and your exit strategies in our second part of this class, and that'll be a separate video, same title, but just part 2. So make sure, do you know when to leave the markets? Because there's 2 parts to every trade. We all know there are 2 steps in every trade: when we open a position and then when we close a position. But we very often get really focused on the first, and often to the exclusion of the second. So there's 2 parts to a trade. Here's the thing though, you don't make any money by opening a trade. That's actually when you put your money at risk. So whether or not you make money actually depends on when and how you choose to close a trade. You can open the trade at the perfect time, but you won't see a cent of profit from it unless you find the right time to close. So get ready to come back for part two, and we're going to talk about close triggers. How do you put together close and open and entry and exit triggers together, not as individual items, and risk reward ratio, and how to make sure you can get out of a trade without losing your shirt if it goes against you, and how to get out successfully when it's moving into profit. So please join us for part two, and we'll talk about where you close your trades and how to do that properly. So thank you very much for joining us today, and please join us for part two of this class.